You might feel comfortable right now. You might think your money is safe because it's sitting quietly in a bank account, untouched, stable, obedient. But let me tell you a truth that will sting a little. That sense of safety is an illusion, and it's costing you more than you realize. Most people don't lose money because of bad investments. They lose money because they cling to the feeling of comfort, to the idea that cash equals safety, and that belief is quietly draining their wealth every single day. Here's the part no one wants to confront. If inflation runs at 3% a year and your savings account pays you around 0.5%, you're not breaking even, you're not being cautious, you're locking in a guaranteed loss of about 2.5% of your purchasing power every year. Not a risk, not a possibility, a mathematical certainty. And the cruelest part is that your bank balance won't show it. The number stays the same, so you assume everything is fine, while in reality, the value of that money is shrinking underneath you, like standing on ice that gets thinner every day. People miss this because they look at the wrong number. They look at the balance instead of what that balance actually can buy. It's like staring proudly at a fuel gauge that reads full, while ignoring the fact that the engine is dying. And I know why people do this. I've seen it thousands of times. Cash feels safe. It feels calm. It doesn't jump around like the stock market. It doesn't scare you. But comfort is the enemy here. Comfort is the trap. Because the money you're trying so hard to protect is slipping away quietly, invisibly, predictably. The truth is simple. And yes, it's a little painful. Holding large amounts of cash in an inflationary world isn't safe at all. It's the most dangerous long-term financial decision most people make. Not because it looks risky, but because it doesn't look risky. And that's exactly how people end up losing decades of potential growth without ever noticing. So before we go any deeper, I need you to sit with this one idea. The biggest financial danger you face isn't volatility, it's sitting still. And if you continue to let inflation eat your money alive at 3% every year while earning almost nothing in return, the math guarantees one outcome. You will lose. Every time. You want to know the real reason people cling to cash even when the math proves it's a losing game? It's not logic. It's psychology. It's fear wearing a mask that looks like responsibility. And unless you understand the traps your own mind sets for you, you'll keep making decisions that quietly sabotage your future. Let's start with social proof. The most deceptive of them all. People assume something is safe simply because everyone else is doing it. Your parents kept money in a savings account. Your coworkers do the same. Your friends brag about how much they have saved up. And because you grew up seeing that behavior over and over, it feels normal. But normal isn't the same as smart. In 2008, countless Americans followed the crowd, buying homes they couldn't afford, hoarding cash because the market was frightening, pulling out of their investments at the worst possible moment. And what happened? The crowd didn't save them. The crowd walked straight off a cliff together. Social proof didn't protect anyone. It only made the damage bigger. Then there's availability bias, the mental shortcut that makes you fear what is vivid instead of what is real. You've seen news headlines about market crashes, people losing everything, portfolios down 40% in a bad year. These stories are dramatic, emotional, unforgettable. But when was the last time you saw a headline saying, Americans lose purchasing power quietly for the 12th year in a row. Never. Inflation doesn't scream at you. It doesn't show up in breaking news. It eats your money slowly, silently, predictably. So your brain fears volatility and ignores erosion. You panic when the market drops 15%, yet feel nothing when inflation takes 30% of your buying power over a decade. But here's the truth you don't want to admit. The quiet loss is the one that destroys people. The third trap is deprival superreaction tendency. Your brain's built-in fear of losing what you already have. This instinct kept our ancestors alive, but today it makes people financially paralyzed. When the market dips, you imagine losing everything, so you run from the discomfort. When an investment fluctuates, you feel exposed. But when your cash loses value slowly, you don't feel the pain, so you stay where it's comfortable. Think back to 2008. Millions of Americans sold at the bottom because the pain of seeing red numbers on a screen felt unbearable. They locked in losses that would have recovered if they stayed calm. Meanwhile, the people who understood their own psychology, who refused to let fear make their decisions, ended up buying assets at the cheapest prices of the entire decade. Same crisis, two completely different outcomes, all because of how each person handled discomfort. So let me tell you something directly, as someone who wants you to wake up. If you don't learn to recognize these psychological traps, you will spend your entire life making money but never keeping it. You'll keep choosing the option that feels safe instead of the one that actually protects you. And the world doesn't reward people who follow their feelings. It rewards the ones who think clearly when everyone else is panicking. You cannot build wealth if you're constantly protecting your comfort. Comfort is where money goes to die. And the longer you cling to the illusion that cash is safe, the more you let your own fears quietly hold your future hostage. There are 3 mental models you need to understand if you ever want to stop money from slipping through your fingers. And I'm not giving you these as theories. I'm giving them to you the same way a coach gives a fighter the fundamentals that keep him alive in the ring. These models explain why your cash loses value, why your decisions often backfire, and why wealth builds for some people and disappears for others. Let's start with entropy. In physics, entropy is the natural tendency for things to fall apart unless you add energy to maintain order. Leave a house alone long enough and it decays. Leave a garden alone and weeds take over. Leave your health alone and it deteriorates. Your money is the same. Cash left sitting still in an inflationary world doesn't stay the same. It quietly breaks down. It loses structure. It loses power. Inflation is financial entropy. And unless you take action, unless you put your money into something that grows, adapts, and produces, your wealth follows the same path everything else does when left unattended. It fades. Slowly at first, then suddenly. The next model is inversion, the one that separates people who make smart decisions from those who keep repeating the same mistakes. Most people ask, "What should I do?" That's the wrong question. The real question is, what should I avoid if I don't want to lose? Always invert. Invert the problem and the answer becomes painfully obvious. If you ask, what are the guaranteed ways to destroy my future? Holding too much cash shows up immediately. Making emotional decisions shows up immediately. Following the crowd shows up immediately. Inversion cuts through the noise. In 2008, the people who survived financially weren't the ones trying to guess the next big opportunity. They were the ones who asked, what decisions right now would guarantee disaster? And then avoided those decisions with absolute discipline. Sometimes avoiding stupidity is more powerful than chasing brilliance. The last model is compound interest, the quiet force of nature that builds wealth for people who respect time and punishes those who waste it. Americans see it every day in their 401k statements and don't even realize what they're looking at. If you put $300 a month into an S&P 500 index fund, averaging around 10%, you're not just saving, you're building an engine. Over 30 years, that engine turns about $108,000 of contributions into roughly $600,000. That's 5 times your money without doing anything extraordinary. Just patience, just discipline. That's compound interest working for you. But here's the part most people ignore. Compound interest works the other way too. Inflation compounds against you. Inaction compounds against you. Fear compounds against you. Every year you keep money idle. Every year you delay investing because it feels safer. You're letting reverse compound interest hollow out your future. So let me tell you the truth is your mentor, not your cheerleader. Entropy means your money decays if you don't act. Inversion shows you exactly which behaviors are destroying your wealth. And compound interest reveals the price you pay, down to the dollar, for staying afraid and staying still. These aren't theories, they are forces. And the moment you learn to work with them instead of against them, your entire financial life shifts. Because wealth isn't built by being lucky. Wealth is built by people who understand the rules the universe runs on and play the game with their eyes open while everyone else sleepwalks through it. Let me hit you with a truth most people spend their entire lives avoiding. If you're holding cash, you are losing money every single day, and the math doesn't care how safe you feel. Inflation in America averages around 3% a year. Your savings account pays you about 0.5%. That means you're bleeding 2.5% of your purchasing power annually. It's not a forecast. It's not a theory. It's a guaranteed mathematical loss. And the cruel part is that your bank balance will never warn you. The number stays the same, only the value dies. Here's what that really looks like. Take $100,000 and let it sit for 10 years. On paper, it's still $100,000. But in the real world, that same money now buys only about $70,000 worth of goods. You've lost 30% of your purchasing power while feeling safe. That's the trap. Numbers in your account don't shrink, so you think nothing is happening. But the world around you gets more expensive, and your money chases it slower every year. Look back at the last decade in America. Housing prices climbed over 50% in many cities. Groceries didn't just rise, they surged. A gallon of milk, eggs, meat, rent, utilities, everything got more expensive. Now ask yourself, did your savings account grow enough to keep up with any of that? Of course it didn't. A 0.5% return is a joke against inflation. And yet millions of people cling to cash because it feels responsible. This is where feelings will bankrupt you. Your emotions tell you the money is safe because it's not moving. But the truth is the exact opposite. Money that doesn't move is money that dies. Cash sitting still is like ice in the sun. It doesn't melt all at once. It melts slowly, quietly, until one day you look down and realize it's almost gone. Let me be blunt with you, the way a real mentor should be. If you keep most of your wealth in cash, you are choosing a guaranteed loss over a possible gain. You're confusing stillness with safety. You're watching the number instead of the value. And that single mistake has cost Americans decades of financial progress. The math doesn't lie. Inflation doesn't stop. And your savings account isn't saving you. If you don't change this, the future you're dreaming of will stay out of reach. Not because you didn't earn enough, but because you let your money quietly rot while telling yourself you were being careful. If you really want to protect your future, you need to stop worshiping cash and start understanding the assets that actually grow your money instead of slowly killing it. Cash is a dying asset. It sits still, shrinking in silence. But these 5 assets work for you, move for you, and fight inflation instead of surrendering to it. Let me break them down simply, clearly, and with zero sugarcoating. The first asset is ownership in productive businesses, what most people call stocks, but I want you to see them for what they really are. Tiny pieces of real companies solving real problems. When you buy into a business with strong pricing power, you're buying something that can raise its prices when the world gets more expensive. Coca-Cola doesn't sit there losing money when inflation rises. Apple doesn't freeze like cash does. These companies adjust, evolve, and pass rising costs on to consumers. That's something cash will never do. And no, I'm not telling you to buy every stock you see. Most people lose money in the market because they don't respect their own circle of competence. They trade emotionally, they chase hype, they buy what they don't understand. But if you stay disciplined, stick to strong businesses, or even a simple S&P 500 index fund, you're aligning your money with growth instead of decay. The second asset is productive real estate. Properties that generate actual income, not houses you hope will magically go up in value. In America, rents rise with inflation. But if you have a 30-year fixed mortgage, your payment stays the same. That means every year you're paying that debt with cheaper dollars while collecting more in rent. It's one of the few situations where inflation works for you instead of against you. But again, circle of competence matters. Real estate is not passive. You buy the wrong property in the wrong neighborhood, and it becomes a headache instead of an asset. But a well-chosen rental property is like a mini business that hands you cash every month and grows in value as construction costs rise. The third asset is the one almost everyone ignores: your skills. In America, specialized skills are the difference between earning $20 an hour and $200 an hour. Coding, sales, trades, digital marketing, design, management. Skills are the engine behind your earning power. And unlike the market, no crash can take your skills away. The right skill set can add hundreds of thousands of dollars to your lifetime income. That's more powerful than any stock pick, and yet most people refuse to invest in themselves because it doesn't feel as tangible as a bank balance. But the truth is simple. The biggest return you'll ever get comes from upgrading the mind you use to earn money in the first place. The fourth asset is high-quality bonds in specific situations. Bonds aren't meant to make you rich. They're meant to keep you flexible. Think of them as the cash you don't want dying in a savings account. Short-term treasury bills or investment-grade bonds can give you a safe parking spot where your money earns more than cash without locking you in for decades. In times of uncertainty, optionality is priceless. But be careful. A 30-year bond yielding barely above inflation is just cash in disguise, slowly losing value. Bonds only make sense when their yields actually protect your purchasing power while still keeping your money accessible. The fifth asset is useful hard assets, things that actually do something in the real world. Farmland that produces food, equipment that generates income, a reliable truck if you run a business. These are assets with utility, not hope. They survive because people need them, not because someone might pay more for them later. Hard assets are the opposite of cash. Where cash shrinks quietly, useful assets hold their ground because they provide real value, even in a chaotic economy. All five of these assets share one thing cash never will. They work, they adapt, they produce, they move. Cash just sits still and dies. And if you don't understand this simple truth, you'll watch your financial future crumble while telling yourself you were playing it safe. I'm telling you this because I want you awake, not comfortable. The world rewards people who put their money where it can grow, not where it can rot. And once you shift your mindset from holding cash to holding productive assets, your entire financial trajectory changes, not by luck, but by design. Let me tell you something most people don't want to admit. Intelligence has nothing to do with financial survival. Smart people lose money all the time, not because they lack information, but because they ignore their own psychology. They know what the right decision is, but they don't do it. They can explain inflation, diversification, long-term growth, yet still fall into the same traps as everyone else. And the painful truth is this: the smarter you are, the better you become at rationalizing your bad decisions. Start with social proof. Even intelligent people copy the crowd because it feels safer to be wrong together than to be right alone. In America, people with degrees from top universities still panic sold during the 2008 crash because everyone around them was doing it. They didn't look at the data. They didn't trust the long-term history of the market. They trusted the fear of the crowd. These are people who can solve complex problems at work, but can't stop themselves from following the herd when their money is on the line. Then there's availability bias, the trap that affects even the most analytical minds. You might be brilliant, but your brain still reacts more strongly to vivid pain than to quiet loss. You remember the headlines from 2008, the red charts, the people crying on television. But you don't remember inflation quietly eating away 30% of your purchasing power over the last decade. You fear the event that makes noise and ignore the threat that never raises its voice. And because the danger is silent, even smart people pretend it isn't there. But the most destructive trap of all is deprival superreaction tendency. the instinct to avoid loss at any cost. This is where intelligent people sabotage themselves the most. They analyze markets. They understand probabilities. They know volatility is temporary. Yet the moment their portfolio drops, they behave like someone who never learned a thing. They panic. They freeze. They run. They would rather take a guaranteed loss just to stop the emotional discomfort of watching numbers move. Brilliant minds destroyed by the same fear that ruins everyone else. Look around America and you'll see it everywhere. Doctors earning $300,000 a year, living paycheck to paycheck because they're terrified of investing. Engineers with six-figure salaries sitting on piles of cash that shrink every year. Tech workers who understand exponential math but still panic sold during the COVID dip, missing one of the strongest recoveries in history. These aren't careless people. These are smart people who know better. But knowledge doesn't save you from fear. Only discipline does. So let me be brutally honest with you. Your intelligence will not protect you from yourself. You can read every book, watch every expert, study every chart. But if you don't learn to control your emotional instincts, you will keep making the same expensive mistakes. You will keep choosing the option that feels comfortable instead of the one that's actually correct. And the worst part is, you'll convince yourself you had a good reason. That's what smart people do. They explain their fears instead of confronting them. And as long as you do that, you will stay stuck exactly where you are, knowledgeable, capable, and slowly losing ground without realizing you're the one pulling yourself backward. If you want to stop making the same financial mistakes over and over, you need a decision framework that cuts through emotion and forces you to think clearly. These 5 questions are not theories. They're the filters that separate people who build wealth from people who keep wondering why they're stuck. And if you're honest with yourself when you answer them, they will change the way you make every money decision for the rest of your life. The first question is about your circle of competence. What do you truly understand? Not what you've heard about, not what you wish you understood. What you can actually explain without lying to yourself. If you stay inside that circle, you make fewer stupid decisions. If you step outside it, your emotions take over. That's where financial damage begins. The second question is about real risk. Not the risk that feels scary, but the risk that actually destroys your future. Volatility isn't real risk. Permanent loss of purchasing power is. Ask yourself, which one is actually threatening me? The third question is about time. What is your honest time horizon? Not what sounds nice, not what you hope for, what you truly need. If you don't need the money soon, keeping it in a place where it certainly loses value is not caution, it's self-sabotage. Time is your ally only if you use it. The fourth question is about second-order consequences. What happens after the thing you're thinking about? Most people stop at the first step. Cash is safe. But they never think about step 2. If I hold this for years, what will it cost me? If you don't think past the first consequence, you're walking blind into the future. The fifth question is inversion. always ask the question nobody wants to ask. If I keep doing exactly what I'm doing now for the next 20 years, what outcome is guaranteed? Not hoped for, guaranteed. If the answer scares you, good, because that fear is telling you the truth your comfort has been hiding. These 5 questions don't give you the perfect answer. They give you the clarity to stop choosing the wrong one. And once you start making decisions based on clarity instead of emotion, your entire financial life shifts, not gradually, but immediately, because you finally stop being the one standing in your own way. If you really want to understand why Buffett and Munger built extraordinary wealth while most people never escape financial mediocrity, you need to look beyond the numbers and pay attention to their behavior. They didn't win because they were the smartest guys in the room. They won because they refused to act like everyone else when the pressure was highest. That discipline is what separates the wealthy from the wishful. Take the dot-com bubble. Everyone was chasing internet stocks like their lives depended on it. Brilliant people, analysts, CEOs, academics, they all rushed in because the crowd made them feel safe. Buffett and Munger looked at the same frenzy and walked the other way. Not because they didn't understand technology, but because they understood human stupidity. They knew a business without profits wasn't a business. They didn't need to predict the crash. They only needed the courage to avoid the madness. And while millions got wiped out, they lost nothing. That's the difference. Most people chase excitement. They avoided stupidity. Then look at See's Candies. When they bought it, everyone accused them of overpaying. The spreadsheets didn't look impressive. But Buffett and Munger weren't buying spreadsheets. They were buying pricing power. A brand people loved. A business that could raise prices without losing customers. They understood something the average investor ignores. A productive asset will always outperform idle cash over time. And See's went on to generate billions, not because of magic, but because of patience, clarity, and discipline. Their entire philosophy can be reduced to one brutally simple truth. You don't have to be a genius to get rich, but you do have to stop doing stupid things consistently. Buffett said it best. We don't try to be very smart. We just try not to be stupid. That's why they survived every crash, every panic, every bubble. They didn't let emotion pick their strategy. They didn't let crowds rewrite their logic. They didn't trade for entertainment. They stayed calm when others wanted chaos. And the market always rewards that in the long run. Here's the uncomfortable part. This is exactly where most people fail. Not because they lack intelligence, but because they lack discipline. They want the reward without the restraint. They want wealth without patience. They want safety but chase excitement. And when the pressure rises, they do exactly what Buffett and Munger refused to do. They follow the fear, follow the noise, follow the crowd. And the market always rewards that in the long run. Here's the uncomfortable part. This is exactly where most people fail. Not because they lack intelligence, but because they lack discipline. They want the reward without the restraint. They want wealth without patience. They want safety, but chase excitement. And when the pressure rises, they do exactly what Buffett and Munger refused to do. They follow the fear, follow the noise, follow the crowd. So let me be clear. The reason they win and you don't isn't a mystery. It's a mindset. It's the ability to stay rational when everyone else is losing their minds. If you cannot develop that discipline, you will keep watching others succeed while you repeat the same costly mistakes. But if you learn it, truly learn it, your financial life changes permanently because you finally stop acting like the crowd and start acting like someone who actually plans to win. Let me give you the last warning you need to hear about cash. Cash has a purpose, but it is not a plan. It's the fire extinguisher in your financial life. Necessary, important, but only meant for emergencies. You need 3 to 6 months of living expenses in cash. That's it. Enough to keep you safe, not enough to keep you stuck. The mistake most people make is confusing preparedness with paralysis. They hold years of cash because it feels comforting. But comfort is the most expensive habit you can have. When you keep too much money sitting still, you're not being responsible. You're draining your future in slow motion. Cash doesn't grow. Cash doesn't protect you from inflation. Cash doesn't work for you. It only waits, and while it waits, it dies. I'm telling you this as someone trying to save you from your own instincts. Holding more cash than you actually need is not caution. It's self-sabotage dressed up as prudence. You're trying to feel safe instead of being smart. The wealthy understand this difference. They keep just enough cash to stay stable and put everything else into assets that move, grow, and produce. So here's the truth you can't ignore anymore. Cash is a tool, not a strategy. Use it for emergencies, not for your identity. Keep the amount that protects you and invest the amount that frees you. If you hold on to more than you need, the only thing you're protecting is the illusion of safety. And that illusion is the very thing holding your life back. This is the last thing I want you to hear. And if you let it sink in, it can change the entire direction of your financial life. Cash is dying. Not today, not tomorrow, but slowly, quietly, predictably. And the world will not warn you. Your bank balance won't warn you. Your comfort won't warn you. But the math will always reveal the truth. Doing nothing is a decision, and it's the most expensive one you can make. You've seen it throughout this entire message. Inflation eats cash. Psychology traps you. Fear lies to you. Opportunistic assets grow while your savings decay. The people who win aren't the ones who know the most. They're the ones who act with clarity instead of comfort. Rational decisions win. Emotional ones keep you stuck. And now everything comes down to you. Not the economy, not the market, not your boss. You. What you choose to do with what you know. Because knowledge is useless if you don't change your behavior. If you keep holding cash like a shield, it becomes a cage. If you refuse to move because you want to feel safe, you trade your future for a feeling that isn't real. And if you walk away from this with the same habits, then nothing in your financial life will change, except the part where it slowly gets worse. So here is the truth, stripped of comfort and excuses. If you don't take control of your money, something else will. Inflation, fear, indecision, or the crowd. But if you do take control, even in small steps, you shift the entire trajectory of your life. Wealth doesn't come from luck. It comes from discipline, from choosing action over anxiety, from investing instead of hiding, and from refusing to let fear make the same decisions you already know are wrong. The choice is yours. It always has been. Cash is dying. The clock is moving. And your future will be shaped by what you decide right now. Whether you stay exactly where you are, or finally step into the life that discipline, clarity, and courage have been trying to give you all along.